Hey guys, Josh and Aaron from the Findlay Mortgage team. In today's video, we want to talk to you about second mortgages. You might have a preconceived notion about second mortgages. You might have heard they're high interest rates. Why would somebody use them? And well, in today's video, we want to break down what they are, why they're going to be effective in today's market, how you can use them, and an exit strategy when looking to get out of them. Now, second mortgages. Thoughts, feelings, emotions?
Yeah, I think first thing we take a look at is, interest rate market that we're in right now. Interest rates have raised quite a bit over the last year at this point. We're taking a look at prime rate right now for variables is 4.7 and fixed rates are sitting in, mid to high fives into the mid to high sixes, depending on whether you're A or B and owner occupied versus rental. And, when we take a look at the interest rates and the environment and taking a look at second mortgages, you might wonder, okay, so what's the correlation? And really what we're trying to do is provide a solution that allows you to tap into the equity that's in your property without having to restructure that first position mortgage that you have. If you got a first position mortgage over the last 2.5 years, you could be sitting in something as low as 1.5%, 2% mid twos right now, which is in today's market an extremely low rate. So when you're taking a look at tapping into that equity, the one thing you obviously don't want to do is restructure that rate, bring it into today's rate, and increasing your monthly payment by probably close to $1,000 if you're restructuring your rate and taking out more equity. What the second mortgage is going to allow you to do is tap into that equity without affecting that rate on your first position, keeping your overall costs as low as possible.
If many of you didn't hear, Aussie is slightly changing the rules in regards to readvanceable mortgages next year. That being said, looking at restructuring debt is going to be the first option for a lot of real estate investors. As Aaron just explained, sometimes it's not going to make sense in a market like this to break your current first mortgage. So accessing equity is going to be very important. A lot of people have heard of second mortgages, high interest rates, but when you start to actually run the numbers and look at the math, sometimes it makes sense to pay a higher interest rate on a smaller amount of debt than it would be to higher interest rate or a medium interest rate over all of your debt. So today we want to talk about how you can actually use that and what avenues you can go down. So conventional financing solutions, some lenders like monoline lenders allow for second mortgages behind their first mortgages. So you don't always have to have a private second mortgage to be able to access that equity. So if you're with a bank, it's quite possible that instead of restructuring all of your debt, they can actually just give you a second mortgage at the contract rate behind the current first.
Yeah, this is obviously a great option. If you take a look at a private second, you're going to be somewhere around 12 to 14% on average. Again, it really does depend on the deal, but that's kind of the typical rates that we see. When you take a look at what today's rates are at, and if you have a rental property and you're on the B side, for example, you could be as high as 6.5% amortized over 30. And when you take a look at what a 10% interest only payment looks like on that small second, it's actually going to be quite competitive in terms of restructuring that whole debt. And what we're actually trying to do is taking a look at what your blended overall payments are going to be between that first and the second versus what a single new payment would be at a full, new first at 75 or 80% loan to value. So really we're trying to take a look at what is the most cost-effective overall cost of borrowing for acquiring a new mortgage and taking out that equity. As we kind of continue in today's market, second mortgages in terms of the loan to values, as the market values of properties are continuing to decline probably over the next year and a half, 2 years. The second mortgages, the loan to values probably are going to be a little bit decreased from where they were before. We were seeing some lenders getting up to 85% in their underwriting policies. We're probably not going to be as high right now. Maybe if you're in the GTA or a really strong market, you might be able to get up to that 80% loan to value. But if you're looking for a second mortgage in around 80-85% up to 90 and above, the standard ask is probably going to be to have some sort of piece of collateral property that we can blanket across to allow you to keep that higher loan to value.
Yeah, in regards to second mortgages, where would you go about getting these types of loans? Most of the time they're offered by mortgage investment corporations or true private lenders in the market. As Aaron said, these interest rates can range depending on your credit score, loan to value, geographical location. When looking to take out these loans, it's important to understand the APR, so the total annualized cost of borrowing. Depending on the type of lender you're going to be borrowing from, there could be a broker fee, it could be a lender fee, and some sort of breakage penalty if you are looking to break the term break the loan within the term of the loan. Some things to be aware of when looking at taking on the secondary mortgage debt is breakage penalty. So if you are with a conventional lender and that conventional lender allows you to be able to put a second mortgage behind their first, Most of the time what they'll do is they will blend it to the end of the term of your current first mortgage. Meaning if you're on a fixed term and you have 3 years left, they will just make it a 3-year term to the end. So when you do go to break your mortgage, you're not going to have a large penalty to break because one term is longer than the other. For a private second mortgage, usually this isn't the case. So usually it'll be a 1-year fixed term and with some sort of renewal cost. So when you're looking at a private mortgage, most of the time for a mortgage investment corporation, the renewal cost is either a fixed set amount or a percentage of the actual loan amount. So depending, sometimes it's 0.25% of the loan amount or a minimum of about $1,000. Now this is drastically less than what you would see with a mom and pop second mortgage. So most mom and pop second mortgages, they will charge their lender fee again. So depending on how large your second mortgage was, they may have a fixed amount that they charge every single time they put their money out, or it might be a certain percentage of the actual loan amount. So when you're looking at differentiating or choosing a lender for your second mortgage, you have to ask yourself, how long are you going to be in this loan? Because if you're going to be in this longer than 1 year, it might make sense to go the conventional private route because the actual cost of renewing that loan is much less than what you'd normally have with a mom and pop lender. But it all comes down to boils down to flexibility and being able to actually take a look at the underwriting and how much can you prove versus not.
Yeah, and then one other thing you might want to take a look at as well too is, do you have an option for an open second mortgage? With the open second mortgage, it's going to give you a lot more flexibility to be able to break and exit a lot earlier without those additional costs. If you're only going to be in the mortgage for 1 or 2 months, you just need it. Maybe you're finishing up some renovations. You just have to spot your contractor, his funds. You got some money coming in a couple months. Being able to break that in 1 or 2 months can be quite convenient without having to pay 3 months of interest on top of that. You might as well just stay in that mortgage for the next 6 months. Now something to be aware of is that when you do go with an open term, whether this is a first or a second mortgage, the lender does typically give you a bit of a premium because they know that you're going to be exiting out quite early. Most of these lenders, as much as they want to help you, they are in the business of making some money, so they do want to make sure they get a solid return for their investors. So you may get maybe an extra point or a point and a half on the interest itself, or maybe the lender charges an additional half a point or a point on the fee. So just be aware of that. And again, it all comes down to just running the numbers. What's going to give you the best cost of borrowing overall? What is that APR going to look like? What's going to make the most amount of sense to you? Depending on the situation and how much equity you have and whether you have additional collateral properties. Something else that we can do is taking a look at bundling in all your costs of the mortgage. We can prepay the mortgage for 6 months, 12 months, the whole year, depending on what it is. We can get your lender fees and your broker fees prepaid as well too. Again, does this make sense? What does the cost of borrowing look like? Do you have enough equity? These are all things that we can do and get a little bit creative to make things as easy and as simple for you as possible.
Yeah, I think as we see a liquidity crunch in the market, I think a lot of investors are going to start taking a look at this option or blanketing a second mortgage on a handful of properties to find a short-term solution. Again, as Aaron said, whether it's paying a contractor to finish a project or mitigating your cash outflow for a few months while you're able to stabilize your properties or get them on the market and sold. There's a handful of reasons why somebody would need this product. It's just important to understand the total cost of it, the flexibility around it, and the fact that we can actually gear these products towards your needs and wants. So when you think of second mortgage, don't think of just this bad negative thing. Think of it as a short-term solution to help you get to where you have to go. We can tailor these products towards what you need. You just need to tell us your strategy, what you need, and we can create it for you.
I think the last thing we want to touch on is just obviously being mindful of the type of market that we are in right now. With value starting to decline, the second mortgage really should be used by experienced investors, for those people who kind of know what they're doing and do have a really firm control over their finances and are comfortable taking on that additional debt. We don't recommend those who potentially are already over leveraged to create more debt. But if you understand what you're doing and you're in a position to be able to pay it off, and you are experienced and you've sat down and you've assessed all the costs, the second mortgages can be a good tool for you to help to expand your portfolio and mitigate cash out of your pocket for some of your projects. Thanks for watching this video on second mortgages, guys. If you found value, we'd love to hear your thoughts and comments down below. Make sure you smash the like button. If you do have any questions, you can leave them below in the comments, but the best thing to do is actually reach out to us directly. All of our emails and phone numbers will be down below, so don't hesitate to reach out.
If you don't follow us on Instagram, please do so. The Findlay team, also the Canadian Real Estate channel. We would love to hear what you guys think.